All right, today we are diving into a term that, completely crashed onto the scene and turned Wall Street upside down, the short squeeze. We're going to unpack exactly what this is, how this market explosion happens, and we're going to do it by looking at one of the absolute wildest financial stories of our time.
So let's just start with this number right here. It's so big it almost looks like a typo, right? Plus 2,464%. Now, you might think that's a crypto coin or some hot new biotech startup, but no. Back in early 2021, that was the insane peak gain for GameStop. Yeah, the video game store in the mall that most people had pretty much written off. This was an event that just shattered all the rules.
So, the big question is, how? How on earth did a struggling video game stock do that? It's not like they suddenly launched some miracle new product. Nope. The answer is way, way stranger, and it kind of pulls back the curtain on a really powerful and super high-risk mechanism that's buried deep inside the market itself.
And yeah, to really get a grip on this whole thing, the GameStop saga is the perfect case study. It's like the most extreme example you could possibly find, and it shows us exactly how this all works. So, the answer is this thing called a short squeeze. It's what happens when a whole bunch of people make a massive bet against a stock, and that bet just backfires spectacularly. It basically turns that stock into a financial rocket ship. But, okay, to really get the squeeze part, we first have to understand the short part.
Okay, so let's break that down. How do you bet against a stock? Well, the whole thing is triggered by something called short selling. And really, all it is a way for investors to make money when they think a stock's price is going to go down, not up.
This whole idea completely flips the classic investing rule on its head. We all know buy low, sell high, right? Well, short sellers try to do the opposite. They want to sell high, then buy low. So what they do is they borrow shares from someone, they sell them right away at the current price, and then they're just hoping the price drops so they can buy them back cheaper, return the borrowed shares, and pocket the difference.
So it's really a four-step dance. Step 1, you borrow shares of a stock you think is going to tank. Step 2, you immediately sell those borrowed shares. Step 3, you wait. You're hoping the stock price drops like a rock. And step 4, you buy the shares back at that new, lower price and give them back to the person you borrowed from. When it works, hey, it's a great strategy. But, and this is a huge but, there's a catch. There's this one non-negotiable rule that makes this whole thing incredibly risky.
There's this old Wall Street quote from the 19th century that just nails it. He who sells what isn't his'n must buy it back or go to prison. Now, you don't actually go to prison, but the point is you have to buy those shares back. It is not a choice. And that mandatory buyback, no matter what the price is, that's the secret ingredient. That's the trigger for the squeeze.
So, what happens when the bet goes completely wrong, right? What happens if the stock price doesn't fall? What if it starts to go up? Well, this is where things get really explosive. This is where the squeeze feedback loop begins.
You should think of a heavily shorted stock like a tinderbox that's just soaked in gasoline. It's an incredibly fragile situation, just waiting for a single match. And that match, it could be anything. Maybe some unexpected good news about the company. Or, and this is a big one these days, it could just be a sudden surge of people buying the stock, maybe because they're all talking about it online.
And once that match is lit, it kicks off this insane feedback loop. Okay, so follow this. Step 1. All this unexpected buying makes the price start to rise. Step 2. All the short sellers start to panic. They're suddenly losing a ton of money. Step 3. To stop the bleeding, they're forced to buy shares to close out their bet. But here's the kicker. Step 4. Their buying adds even more fuel to the fire. It creates more demand, which pushes the price even higher, which forces more short sellers to panic and buy, and you get this crazy self-feeding rocket launch.
So, the natural question is, can you see these things coming? Well, they're famously unpredictable, but traders do look for certain red flags. There are a couple of key numbers they watch that can tell you when a stock might be getting vulnerable to a squeeze.
There are two main indicators people look at. The first is called short interest as a percentage of the float. Whoa, that's a mouthful. All it means is what percentage of all the company's available shares are currently being shorted. A really high number means a lot of people are betting against it. The second one is days to cover. Think of this as how long would it take for every single short seller to escape their bet, based on how many shares trade on an average day. A big number here is a huge red flag.
And just to show you how absolutely nuts the GameStop situation was, take a look at this. For a typical stock, the short interest is usually under 10%. If it gets over 20%, people start saying, whoa, that's a highly shorted stock. But GameStop?
At its peak, the short interest was over 100%. You heard that right. More shares were sold short than were even available to trade. I mean, the tinderbox wasn't just full, it was literally overflowing.
And for that other metric we talked about, days to cover, a number of 10 or more is considered a major warning sign. It's the perfect analogy. It's like a really crowded movie theater, but with only one tiny little exit door. If someone yells fire and everyone tries to get out at once, you get a stampede. And that stampede, that is the short squeeze.
Okay, this brings us to what is maybe the most important part of all this, the risks and the reality. We're talking about the incredible danger here. A short squeeze isn't just some funny thing that happens in the market. It's a brutal financial battle, and it can have absolutely catastrophic results, all because of that unique, crazy risk that comes with short selling.
So check out this asymmetry of risk. It's why shorting is so dangerous. If you buy a stock, say for $100, the worst that can happen is it goes to zero. You lose your $100. That's your max loss. But when you short a stock, there is no ceiling on how high that stock can go. It can go to 200, 1,000, 10,000. So your potential loss is, and this is not an exaggeration, literally unlimited. Your max gain, though, it's just capped at what you initially got for selling the shares.
And look, it's not just the short sellers who are in a dangerous spot. If you're a buyer thinking you can ride this rocket ship to the moon, you have got to be careful. You have to remember, these crazy prices have nothing to do with what the company is actually worth, and that momentum can reverse in a heartbeat. When the squeeze is over, the stock can fall just as fast or even faster than it went up. And think about it. If you're buying at the very peak, who do you think is selling to you? It's probably the short sellers who are finally getting out.
So at the end of the day, a short squeeze is really just a temporary, high-risk situation. It's driven by market dynamics and a feedback loop, not by the company's actual performance. It's fascinating, it's chaotic, for sure, but it's not going to last forever. Eventually, gravity always wins, and that price is going to come back down to reality.
And all of this leaves us with a really big, thought-provoking question, doesn't it? When a stock's price gets so completely unhinged from reality, are we just watching a powerful market force play out? Or are we seeing a sign of a fundamental market failure? It's a huge debate, and it's one that definitely keeps going long after the squeeze itself is over.